So we have yet to start from zero to hero and explain everything about providing liquidity. We were waiting for you. So like we can like, where would you like to start?
There should be a little bit of a structure. We should start with explaining what V2 is, how that works, go into V3, and then explain V4 and how they compare. And then we should like structurally go forward from there. Just so at the very beginning of this recording, everyone's kind of at zero and can build
So
from
in
there.
regards
That's my
to
recommendation.
V4, the only thing I would say is I say we stick to V2
And
and
V3, yeah.
V3 because I don't want it to get over people's heads because number one, mainly everyone who's in this space are on Pulsechain and we don't sadly have V4. And so I feel like we should just stick to V2 because I did actually have some questions in regards to why should I, like, what's the difference between V2 and V3? Because you don't earn fees, right, on V2, but you earn tokens from what
You
my
actually
understanding.
you do actually earn fees. So what happens is in that in V2 there's actually a compounding mechanism, meaning that every time there's a trade, a fee gets added on to the pool. So the whole amount, because in V2 inherently you always have to put 50-50. You have to put $100 of token A and you'll have to put $100 of token B. The beauty about V3 is that you're able to do exactly what you want without having to always risk yourself into both assets. So you don't have to provide half and half. You could provide only one side, or you could provide a percentage. So 90% on one side, 10% on the other. You could wait with V3, you could wait so you could get the 5x gains that you're hoping to get. And then you could say, well, hey, if it goes over 5x or 500% from this point on, I'll sell it from 5x to 10x. And then in between that, when it reaches 7.5x, you could assume that then you have a type of 50-50 liquidity. So what you could be using, and what I would stress people to understand is, don't think about us trying to pitch you V3 as a way for you to come in and be a whale or a market maker. What we're trying to explain to individuals is that this is a mechanism that you could be more hands off, but having to deal with, I want to take profits, right? You could take profits at 100%. You could create as many V3s as possible, depending on what you're willing to do. Are you willing to DCA in? Are you willing to DCA out? V3 allows you the flexibility to do that. And that's why I really prefer pitching V3 than V2, because V2, you necessarily have to have the funds from both ends. So what happens, and especially in Pulsechain, this happens a lot. Individuals will go get a pump tire token, right? And they'll be first to buy. And then what happens? Well, they have a certain amount of percentage of supply. They get their gains and they say, hey, I want to trim off my bag. So what do? You go ahead and you go on the DEX and you go do a market sale. Now, off the market sale, you have the slippage and you have to pay the fees for the DEX, which are we all don't, not a lot of people care about that because it's always inherently in the price. So when you're on a V2 structure and you're trying to sell through the market, you always get less than what it tells you you're supposed to get. That's why there's always you might get this, or you have to fix a slippage to put 1%, 2%, 3% slippage, because it may or may not change the price and you may or may not get exactly what you want. But in V3, you are inherently saying, I am selling a token at this price and I want to buy back a token at this price. So whatever you want, you actually receive it. And then the benefits of V3 is that you're actually getting paid to do it. Because if your coins are being utilized, whether it's for a buy or a sell, or if you're on a sell wall or a buy wall, you always get paid. And you decide how much you're willing to charge. Do you want to charge 2%? Do you want to charge 1% fee? Do you want to charge 0.25% or 0.05%? So it's very interesting to show the power that one has. And then with that, you could learn the basics of market making, in my opinion. But it's
Slow,
interesting to
Palavan,
learn.
slow, chill out. You have already now
Why am
explained the
I
entire.
actually going fast?
Going back to my example of why would you want to provide liquidity for a stable coin at the $100 range? Does not make sense. So let's not even put our liquidity there. Let's concentrate our $100 that we have at only the point where the asset most likely will be traded. For the stable coin, that will be $1. For Hex, That will not be $100. I can tell you, it will not be $1. I think in the next couple of weeks, it will trade between like 30 or 40% of what the current price is. So in V2, you are forced to spread your liquidity. In V3, you can use the ranges. And that's like really the main difference when it comes to me. When somebody asks me, what's the difference between V2, V3? You can choose your ranges. You can be more capital efficient. I think that's the bottom line there. But then there are even more like benefits and, differentiations between of that. Like as long as you talk about it, the more like, possibilities you will find between V2 and V3. Like maybe to add just another sentence, V3 allows for sophisticated liquidity providing strategies. Like if you think about it, V2 does not allow for that because you are forced to provide two assets. V3, you can even do one asset. So that allows for a lot of strategies. We will go later into that.
Can you explain what impermanent loss is on V2, and then can you explain how someone could minimize their impermanent loss on V3?
It's basically the same on V2 and V3.
No, 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 no,
No,
no. See,
no.
this is where we argue. Okay, so in V2, you actually everybody is receiving the compounded fees. Therefore, you don't actually have what you start with. Now, because of those compounded fees, what happens is that if there's individuals that want to go ahead and manipulate the price, but also have a bigger position than you, they can go ahead and remove their liquidity, which will forcefully change ratios because of how not thick it is anymore. And you have a possibility of either losing more on the way up and losing more on the way down, meaning that you actually never end up with the same amount of tokens. So you could add, so it's not really like something that occurs every time. It's really dependent on the parameters that are occurring. If something goes up, down, how much is it compounding, who's dumping, who's selling, who's removing their liquidity. It's all a bunch of, it adds up. And the consequences is that in V2, you're not guaranteed to end up with what you have. In V3, if the market goes up and then comes back down, you are always guaranteed to end up with the same amount of coins. So if you put in 1,000,000 Pulse and you do it against PulseX, and somehow, some way, you get filled completely and you have only PulseX, and then the market decides to again use your PulseX as the liquidity, because when you're in V3, you're always constantly providing a side. So if it goes up and somehow comes back down, which makes it come back to the exact same point that you started, well, technically you're 100% guaranteed the amount that you started with. You will have 1,000,000 Pulse in it. So for me, it's not about impermanent loss, because there is no impermanent loss even if you wait. What Abit and I argue about is once you do get filled, once you are selling off your tokens, slowly but surely, you lose out on the opportunity to get those gains. So if, let's say the token goes up 20% and you've been selling off since 5% gain to 20%, well, that 15%, you're basically selling the tokens off every 1% it goes up. So you technically miss the opportunity to have 20% gains on your whole bag. But that's not an impermanent loss. You're basically telling the system, I want to do this. So everything is actually happening the way it's designed. In V2, you're not guaranteed to end up with the same coin.
Brother, but you just described impermanent loss to a T by definition and then said it wasn't.
Well, no, because in V2, you actually could have less, but then what happens if someone comes in with more coins and adds more to the PLP? The ratio then after that, the buys, because let me explain it like this. In V3, you're always providing the same amount of coins every tick. There's no way that you end up with more coins or less coin in that tick.
Because of the separation of fees.
No, because of the concentration of your liquidity. So whether you do a full range, right? If you do a full range in V3 or you do a 30, 70%, you're basically telling it, I'm giving you this many tokens for this amount of ticks. And it will properly disperse each and every single one of your coins. And it'll always be the same because, like I said, there's no way for you to get more coins or have less coins. In V2, because of the compounding effect, someone can come in and monitor and edit the ratios, and because of the compounding, people could then take out, and the effect will be different to your bag, which doesn't guarantee you the same amount of coins every time the coin goes up or down.
I don't know if it's use. I'll say this is I don't know if it's useful for us to discuss this, but there's an argument to be made because you would be moving the ratio by selling the price down. So like,
Yeah, but it's always you
I don't
always
know
do
if
the
we
same.
discuss
So
this.
if we do 10% down, right? Like if we're doing a 10% down on V3, you're technically selling 10% of your bag every 1%. And every percent is the same amount of coins. In V2, it's not the same amount because as you sell off, the compounding,
Yeah, it's a curve.
exactly, it's the
Yeah.
mathematical equation because it's 50-50. You're actually creating the opportunity for you to get more if you're a bigger player. But then once you take it out and then someone comes in and and does something to the ratio, it doesn't guarantee that the person will have the same amount of tokens. But for me in V3, no matter what the price is, every tick I'm always going to have the same amount of coins, whether I'm buying or I'm selling. That's why when you go from one way, you're always guaranteed to get, like if you put 100% up, you're getting 50% on your coin. Like you're getting that 50%. And when you come back
I
down,
see what you're saying.
you're
Yep.
guaranteed to have your 1 million pulse that you technically put in at the beginning. So there is never impermanent loss.
So the distinction though with V2 would be that if your range is in V3 is that if in V3 your range is too tight, you're instantaneously priced out of the market, whereas in V2 you would continue selling your coins into the higher market.
In V2, the mathematical equation that balances an LP, because your PLP tokens is a representation of 50 to 50%. Sometimes it varies and it goes 50.6 and 40, like, you know what I mean?
Yeah.
So you're
X times Y equals K, right?
exactly. Well, there's one other
But
like thing in there, but it's a mathematical equation, which means that if you have this many PLPs and there's this many PLPs that exist, then you're entitled to take out that much per token. So you're not actually guaranteed to always take out the same amount. But in V3, you're always taking
no,
out the same amount.
this is a misunderstanding. PLP tokens are unaffected. They don't change the amount of liquidity that you're entitled to. They remain constant.
Well,
Because I've heard this before.
well, yes and no, because
I think
the PLPs
I think the better way to
represent
articulate this.
the PLPs represent the 50 to 50%, meaning that you're able to take out. But what happens when you do a transaction and there's compounding on that transaction from one side, because you're not compounding the side that you didn't
It's
get as
just
a
a
fee.
share of the pool, though. It's just share of the pool.
Yeah, yes, but you have to understand something is that because of the compounding, you're not guaranteed each time it goes up 10% or it goes down 10%. When you yank your pools and you go get back and you withdraw and you remove your PLP, you're not guaranteed to have those coins. In V3,
I think what you're trying to describe is that your fees are paid in the coin that was depreciating.
yes, but that could affect people and have them deal with impermanent loss, because you could have on one time it goes up 10%, and depending on the volume that it took to go up 10%, there's compounding that's happening, and then people could come in and profit from that, or take something, or edit the ratio, or do something to the pool, which eventually means you're not supposed to get where you actually were supposed to get.
Giga made a good point that when you say the term edit the ratio, it makes it sound like someone can just like change it, but you have to buy or sell to edit the ratio.
Yes, but editing the ratio, I just mean like someone yanking their liquidity and then dumping one side of the coin.
No, but adding and subtracting liquidity doesn't change the ratio. It's only buying and selling.
No, adding and like famous is definitely
Okay,
right,
very
but
small, like
we're going
very,
we're
very,
going
very
into
small
debates
amount.
here.
Tiny
I
amount.
understand why I'm saying it wrong, because you're not actually editing what I mean is you're affecting a change in the ratio. But because of the density of V2, you might not end up with what you're supposed to get. In V3, if you have 1 million pulse and you put it in at one point and you say, I want 20% gains, so I'm selling off all my coins for 20% gain. Every time it goes down and up, down and up, down and up, you will always end up with the same amount of pulse and the same amount of PulseX. So even if you pull it at 17% filled, you'll always have the same coins. You'll always have the same amount of PulseX. Just like when it comes back down, you're guaranteed to still have your 1 million pulse. But so if it goes up 25%, you'll always have the same amount of coin. Whether it goes 20% and back to 0%, then back to 20, then back to 0, then back to 20, it's always going to represent the same amount of tokens, and it can never change. You're guaranteed to always end up with what you want. You can calculate how much
I don't want to get hung up. I don't want to get hung up on this, but I think there's a misunderstanding in this one point, because if the price, if you're in V2 and you're in V3, and let's say your V3 position is a 10% up and down range, right? And your V2 position is obviously scales, right? If both of the prices in that example went up 10% and then came back down 10%, you would come out even on both sides. You would have the exact same amount of money plus your fees on both of those positions.
Not necessarily, because of the compounding. You could actually end up with less because of how dense the ratio is. How dense? No, not dense the ratio. How dense you are compared to the whole plot. If someone comes in with a shitload of PLPs, you could come out and you'll not end up with the same token. Even if you sell off one side and go back into your token, you'll never have, like, it's very rare that you end up with the same tokens. But in V3,
but the PLPs are just PLPs are just a physical representation of 50% of
but
each
the
side,
impermanent
right?
loss, when someone actually inherently says you're getting impermanent loss, it means that sometimes people use it as a price, but it's not a price. It's about how much you have, because you could start with 1 million pulse, sell half of it, end up with 500,000 Pulsex and 500,000 pulse, and the way that it ends up, even if the coin goes up 20% and comes back down, you could end up with 480 pulse and 480,000 Pulsex. So that's in my point, it's impermanent loss. Because no, you could stay in the pool, you still have 50-50, but you don't end up with the same coins.
If you're saying that, say, the price moves up and then someone comes in and adds massive amounts of lick, dilutes your share of the pool, and then it moves back to where you start, I'm pretty sure you still end up with exactly your initial input plus fee.
No, because it's you're getting
so
0.22% of your weight.
So you should end up with no impermanent loss.
You're not getting 0.22 on actually what you have. You're getting it on the weight of how much you represent. So if someone comes in with 70% more, then you're actually losing on compounding, and you're losing on the opportunity of getting back what you started with. Because then they can
you'll get less fees on the way back down, but you'll still end up with no impermanent loss. You'll get all your assets.
Yes, but if you
guys, I love this conversation, right? But like, I feel like we're going a bit
it's a
too
super
complex.
conversation.
This is like, even it's going over my head a little bit, right? And I feel like this space
Because
was
you have to
created for the
understand, dude,
newbies.
it's people, the newbies, when they hear impermanent loss, right? First and foremost, they get scared. But if you were to explain to them that on V3, you never lose coins, even if you sell it off and you miss the opportunity, every time it hits that 20% up from the point that you put in, you have the same amount of coins. The sale, when you're selling something in ticks and you're saying, I only want to sell up to 20% change of ratio, you will always be, when it's 20% and you're filled, you'll always end up with the same amount of coins. Yes, you'll have more fees, but when it comes back down, you're like 100% guaranteed to have the same amount of coins.
But you can't say never. You can't say never, because the way you're explaining
Sorry,
it.
guys. Can we move on from this?
Let's leave this argument
No,
and
but
nevers and evers
but wait,
for
no,
later.
because a lot of people don't understand the point that I'm trying. Because what people think when as individuals that are experienced in crypto, we understand the term impermanent loss. But those who want to get in, they hear this negativity and think they're going to lose. But on V3, you just lose the opportunity of holding, which it's not about impermanent loss. It's you're telling the system, I want to sell my coin, right? What is done is happening.
Bro, that's
But in
just
V2,
framing.
it's not like that. But in V2, it's not like that.
All right,
You
guys,
could say
look.
that with V2.
Right, look, number one, this is about V3. Okay, number one, this space is about V3. Number two, I wanted to start with the basics. Okay, the basics. And the basics are what's pinned, the first message that's pinned. When you go, look, as a new person who's going to use V3, okay, we're trying to onboard people here to use
Yes,
V3.
of
We've
course.
pinned Panos has pinned the 9mm front page, right? When you go into the V3 section,
Yeah.
and the 9-inch V3 section. Obviously, people are entitled to choose whichever one they want to choose.
Of course.
I wanted you guys to kind of explain everything on that page in regards to the new people that are trying to provide liquidity or want to learn how to provide liquidity. Because, for example, me, when I went on that page the first time, I was like, this shit. Okay.
Let's do a step by step of how to do it then, right?
Yes,
Let's
yes.
do a step by step. Okay, so I'll try to pull up the 9-inch, but I have the 9mm up right now, right? Let's take Pulse and Pulsex because it's probably everybody's favorite coins, right? So with Pulse and Pulsex, you end up with the button, you click add liquidity, and then you choose where you want to do add liquidity, you choose the V3, and then in the V3, you have the tiers. So on the top, you have the choice of your coin. You would choose you would replace 9mm with PulseX. So like that, we're against Pulse and PulseX. Now it depends. Now what's tricky is that sometimes, right? Because in order for you to sell coins, in V2, you have to provide the other side that's not being utilized. So if you have $20,000, right? You started with $20,000. Okay. If you're doing a V2, you are only selling $10,000. So you could only make gains on selling the token higher from $10,000 of one side. When you're on V3,
Can I interrupt here for a sec?
Yeah, Giga, do it.
I think impermanent loss isn't something that should be discussed. I think people are worried about opportunity cost, but we're not worried about impermanent loss right now. And I think we just should move
let's
on.
continue like that. I completely agree.
Can I just finish what KO was trying to say? He said he wanted to sell $10,000 worth of tokens. He decided to use V3. Let's say the token was at $1. He tried to sell it at $1. He would have probably got 9,800 because of price impact. He used V3. He got $11,000 because he used V3. Yes, there's still. Well, I'm going to bring back that impermanent loss thing. Yes, there was still impermanent loss, but in his eyes of his example, he is actually up over
Yes,
$1,000.
that's where I
Yeah.
was trying to basically come in, guys, because like for example, like I've said in the past, I've only used V3 liquidity to set up a sell wall, and obviously once that sell wall's clear, I'm happy with selling 20% of my position of a token via V3, not eating no slippage, earning fees, and I still, if the price does move up, I still have 75% of the bag which I had, and I've took profits out of that token. That's the only reason why I was a bit confused in
Yes.
regards to permanent loss. But all
Yes.
good in the hood.
Yeah, so what you're saying in that example, you wanted to sell that 25% anyway. You've actually made more than actually selling it on the market. But you
Yeah.
are also suppressing the price. So if you're in a token with low liquidity and you're trying to do this, you are also suppressing the price because you have a tight range. Keep that in mind as well.
Yeah,
If
yeah,
you're in a
I
token
get that.
like Hex and so on, yes, you still are suppressing the price, but there's so much volume and volatility there that only a big shark can actually make an impact.
Okay, I get that. So I see Too Spooky got his hand up. Welcome, bro, to the stage. And Crypto Prophet, after I see you got your hand up as well.
Yeah, what's going on? I'm actually glad this conversation is being had because I've been a big advocate of liquidity providing, just in general, V2 or V3, but I've been a big advocate of liquidity providing in general. Not enough people talk about it, not enough people do it, and they all just wait to dump on each other. It doesn't work. But I'm actually glad right when I came up here, Giga made a really good point, and I've said this before. Most people confuse the concept of impermanent loss with opportunity cost, and this is why I actually hate the conversation of impermanent loss because it's a unilateral thinking, and people just think about it the wrong way. It's so much easier to grasp why V3 is so good if you just understand you have a fluid position that you set, but you have a fluid position in a range that is dollar cost averaging. If you get the impermanent loss out of your brain and you think about how much money you're missing, which again is opportunity cost, it is dollar cost averaging between two tokens that you want. You might want to get rid of one for more of the other, but it's just dollar cost averaging. So when you understand that mechanic of I want to sell this one token for this other token at this specific price range, it starts clicking when you actually start doing it. And permanent loss is a bad talking point. Absolutely hate it. Dollar cost averaging is the way to go when you're thinking of V3.
Beautiful.
That's very well said.
Let me add on to that real quick. When you're setting a V3 position, you're kind of just offsetting the future sell pressure to someone else. The alternative to that, right? Like in Abit's case, you're going to get 10% slippage and you're going to make a red candle. It's functionally the same thing, and I would argue that it's worse because if you're just waiting on someone else to come by and you're just going to dump on them, now you have put onto the rest of the market and everyone else lower prices. So yeah, there might be, depending on how the size of your bag, there might be some resistance on the price chart going up because you're making the market buy your tokens directly off of you via V3. But the alternative is to have people at a loss. And I don't think, I think that's why V3 is so important. I would rather offset some resistance rather than offset some red candles, because now you need another buyer or multiple buyers to come in because some shark or whale decided to dump on everybody right after you bought.
So this is like one of my main actual rebuttals for you. So like this was, I mean, we don't have to get into the weeds of this until later after we figure everything out. But I mean, we could discuss that later about the like putting the red candle into the next guy
So I
thing.
wanted to basically look. I wanted to split this space apart from different things. I wanted us to speak about V3 buy walls, V3 sell walls, V3 50/50 providing liquidity and earning fees. What's the benefits? What's the negatives? And how to actually do it. You know, for people to understand. Maybe we can kind of like structure the space in that regard.
I would suggest people to come up with questions, right? A Telegram. It's important for people to have their unique questions. If everyone were to understand it, in my opinion, it's not. That's not. I think the outcome today is to get people to try to listen, to look, to try to understand, and if they don't, to come up with their personalized questions, so like that they can understand of why they would want to do V3. How could V3 be profitable for them? Because of their goals, their crypto goals, and so on and so forth, right? Because some people might think that they want to do this, but they want to just hold the bag and hope for massive speculation appreciation. So I think it's important that people understand that you should have questions, and we'll be running in the Telegram more specific, just questions and questions, because right now we have too many good people with experience, and we should have these discussions. And I think rebuttaling each other or debating each other right now could come out of it. So I love the conversation because we need to understand that people are going to have questions, and we need to set up people to think about, I don't understand this. Okay, this is a question that I'm going to ask. So let's continue the conversation and not try to argue about semantics. Let's just go into like how Giga was explaining. We should maybe look and compare the photos so people can understand what is happening. So if they don't understand what is occurring on a photo or on a chart, that they would have a question and say, well, I don't understand why it says this number or this, or why would I put it in this or not this? And we should stop having the arguments, right? So I think we're doing really well right now, man, in my opinion.
It's actually a really good point, which is why I want to hear Giga's rebuttal, because I think I know what he's going to say, and I already have the perfect analogy why I have my position. So, I mean, a tangent, if you don't mind, Giga, please give your rebuttal, because like I have this philosophy for a reason.
Yeah, I mean, I haven't really prepared anything, but I would argue that if you're encouraging, you know, if you have a community and you encourage them to provide their token up for, you know, and they have tokens that they're trying to exit into, like, let's say DAI, um, then you're saying, okay, here they are, put them on the market, and you know, hopefully the market can absorb these tokens. And when what you usually see is when the market does absorb those tokens, they will pull their DAI position, and they got what they wanted, you know, out of that deal. But the problem is that they've now absorbed the existing sell pressure on the market, so you have to have more sell pressure, and the price can move against you or, you know, higher easier, but at the end of the day you've removed value from that community, so the next guy, if he does sell, is going to do more damage than he otherwise would have if you just had V2 positions. Hopefully that wasn't too
Nope,
convoluted.
fully understand it. That's where I thought you were going. So this is my philosophy on why the V3 strategy, which is very similar to like an OTC trade, in my opinion, why I have this philosophy is because I like looking at these tokens like real estate. To me, it's all digital real estate. I've been saying the same thing for a couple of years now. So imagine if the housing market operated with a pool of funds that was a collective of every single house sale on the market. And if you ever wanted to sell your house, you could immediately sell your house in just a couple of minutes, and then you can extract the value that's backing every other house on the market. right? You could sell your home for
Fungibility.
right. You could sell
right?
your home for $500,000, but at the cost of lowering the pool, that is what all the other houses on the market are valued at, right? It doesn't work like that. Housing market would crash overnight if everyone could click the button and sell their house at any given moment. And you're not always going to have that demand there to increase the value of your houses. The way the housing market works is that it's OTC trades. If you ever want to sell your house, someone has to come in and buy it, usually at a profit. Some people sell houses at a loss, but someone has to come in and directly buy your house off of you. And inflation aside, that is the reason why housing prices keep going up and up and up, because when you buy your house, you sell it directly to another person. You don't sell it based on the value backing that every other house was sold for in a limited pool that can't actually equally back the value of every house. You can have 1,000 houses on the market, all for $500,000, and selling one house is not going to crash the price of the other houses. If anything, if you're selling that house for a profit, might increase the value of the other houses, because that's what the market is dictating the prices at. So I think V2 and the ease of V2, or just the ease of being able to market sell from a pricing that's from a limited pool, has distorted the worldview of what value actually is and how people function and extract value from each other. Whereas with something like V3, you can have this system that's very similar to real estate, where you can say, I'm not selling my asset, I'm not selling my digital real estate for lower than this price. Someone else has to come in, buy it at that price if they want it, and then they have to participate in the same system. Most people, 99% of people, do not sell their house for less than they paid for it. They sit on it for a while and they wait until someone is ready to come in and buy it at a higher price. So I'm a bigger fan of V3 because in the long term, it's more functional for this OTC like system, where you're only ever going to sell it for more value than you thought it was when you purchased it in the first place. Whereas the market selling on your friend's strategy just does not work in the long run. We don't see it in the real world.
So I agree with you on most of it, right? In that, you know, in a rational kind of market, yes, it totally makes sense. But the reality is that, like, it would be like, I don't want to get too hung up on this, but the way I perceive this is, it's like if they had thousands of houses that they were trying to sell at once. And to kind of touch on, your explanation, and I kind of forgot my point as I was listening to you, but you are artificially, I won't say artificially, you're propping up the market with less liquidity over time in those instances.
I agree with you. That's because the concept of liquidity, I think, is a false paradigm that we have got comfortable with because of things like V2. There's really no such thing. It's just supply and demand. Who's willing to pay at whatever price it is, and who's willing to sell at whatever price it is. So this whole concept of liquidity, I think, has ruined the mindset of a lot of people who do want the convenience and ease of market selling, but there's really no such thing, because if a whole bunch of people came in and bought an asset and you see a bunch of liquidity, no one can all sell their tokens for profit. In my opinion, because of that, it's highly flawed. Where if you're just sitting on property for a long period of time, however long you want, and you're ready to sell it, just like in real estate, you have to wait for a buyer. That's how the real world actually works. And the V2 system of liquidity providing, X times Y equals K, it allowed us to do things wrong out of convenience.
Well, I'll say this. I do agree, and but I also do think that the V2 model is critical for for the system that we are participating in, specifically because 99.9% of the market isn't going to manually market make themselves, and V2 is just the hands off way to do that.
Yeah, yes, because
I also agree with that.
a healthy
Hold on, famous.
a healthy liquidity position would have both a V2 and a V3. That would
Yeah.
be very healthy, because you're using the V2 as the base liquidity, saying that we would like to have this much backing, this much of the token to then
Yeah,
represent its inherent value. But the
and I'm always
V3 comes in
offering some.
exactly. V3 is a tool to to allow the market to say, I want to concentrate the position for many reasons. You have three main reasons, in my opinion. One is because people are saying, I would like to offer this to someone, and my get out price is between this and this, or just this. The other one is I'm willing to tell the market that if they go ahead and sell me this much, I have a bag to buy it up between this and this. And then the other one is I would like to get a piece of the fees that's going through the actual inherent value, which should be V2, and I would like to dilute it, or I would like to create more, to have it more liquid, right? So in order to concentrate more liquidity between a range, because if people
I'm
believe
not
that
Can,
the
against
best,
that. I'm not
I'm
against
not
V2.
can
I'm
I?
not against the concept of liquidity, like LPs existing how they do on, EVMs and some other chains. I'm mostly focused on how the community interacts with it, right? So the point I was about to make. So if everyone came in and bought it, like say you have an initial LP, right? If everyone came in and bought the token and everyone only sold the token, they market sold, it's just not a system that survives. And the more people that participate in this OTC style of trading by popping your bag in LP and waiting for someone on the market to buy it, it has more longevity because that's what we see in the real world. I'm not against V2s. I'm not against full range liquidity. All of my tokens launch with full range liquidity. But the more people that refuse to participate in a system with longevity, the worse things are going to get for this system of trading and value extracting because like I said, that small resource compared to everyone holding liquid bags, it's not extractable by most people. And the more profit someone has in any given token, the less profitable it is for the other participants. It's just not a system that works. So I think in
So
crypto,
you could simplify it,
go ahead.
right? You could just simply say that you believe in a market where if you're incapable of producing new buyers, you're leaving the existing holders. You're having the existing holders hold on to the asset until they find new buyers instead of them forcing the asset onto buyers through liquidity that are the ones propping up the market in the first place.
Effectively, and to your point, I also agree that the current system that we have is heavily reliant on this the mechanics of liquidity providing from zero to infinity. It's heavily reliant on this what everyone is just comfortable with, but I don't think that it's right to continue down a road that encourages things that don't work. And I think it's a lot better if more people woke up and started going in the right direction. It's not an easy battle at all. And it might not be more comfortable for people to do to be patient and sit on digital real estate for longer. But in my opinion, it's 100% the direction that we need to go because it's the only system that actually works in the real world.
And I just want to say one last thing, and then I swear I'll stop. Um, yeah, I'm just trying to think of a good example, and I haven't gotten to think it through to its conclusion, I guess necessarily. But if let's just use 9 millimeter as an example, because I know there's a lot of discussion around it, especially with the Tang gang and you guys. So if I was looking for an entry into 9 millimeter, would I rather as a whale enter a position because a bunch of your community has like a relatively tight range of liquidity at this point, or would I rather and basically buy their positions for them, and I could get a lot of tokens at this price for since there's so much concentration here for a relatively cheap price without slipping in against myself too hard, or would I rather the market be thicker and the price to move down slightly and then purchase my position then and that way I know that, like, let's say it's the DAI that I paid into that pool is distributed equally amongst all of the liquidity providers based on their share of the pool. I feel more comfortable entering a big position knowing that that liquidity is being dispersed among anyone with the LP tokens rather than, maybe two or three guys with all of the concentration of liquidity down there, because I would expect them to remove it right after.
All right, that's actually a good point, and I'm glad you used 9mm as an example. So here's how I see something like 9mm as well versus like just a generic meme coin, right? Just like housing, there's a long-standing history of housing and where the economy is going, and you can track the trend line of, the value of a home. So most people, they're not buying homes thinking that the price is going to go up, overnight. You're not going to get the cyclical nature of, 1 or 2 years up, right? So people don't trade homes. So the question, if you want to compare it to real estate, the question is, should you have bought, like, in my opinion, a good analogy for the question is, should you have bought a home in 2009, or should you have bought a home in 2022 or 2023, whenever we had this most recent housing market slight crash where things gone down like 20%, right? Does it sound better to buy after a housing market crash? Sure, because the prices just came down sharply and now's your opportunity to get in. But you only see that based on the perspective of the trend of where it's going. So if you have a community that is providing liquidity at a specific price range and they're not selling it, effectively you're boxed into a position where you see the value, you see where it's going, and you have to choose, like, hopefully you get a market crash, but the more people who are choosing not to crash the market, the more you're going to be forcing to miss that opportunity cost. So something like
Sure.
9mm works. So the question really becomes, with the utility token that's paying passive income, do I want to wait for a digital real estate crash for this specific token if I see the value that's already there? People buy houses for utility, to live in, to rent out, or whatever, or passive income or speculative value. No one's buying it to flip. Well, most people don't buy houses to flip.
Well, I'll say this: I don't necessarily like the real estate example because it's more closely, obviously, like we could relate it more closely to the S&P or something like an index. But I will say that the point is that I like is that if 100 of your community members are all providing, even just ask liquidity at this range, it means that they're not willing to give up tokens below this price, meaning that the market agrees that this is a fair price. I think that that's a fine kind of middle ground or agreement, is that you can see the strength in that the market's not willing to give up their tokens for cheaper than that price, right? So they're just going to ask that someone come buy them rather than give them up for less.
Yeah, I mostly agree with everything you said. I think the only real difference is what is the best course of action overall and going forward for, I think, an individual, but also for a community and crypto. And I think that trying to push people in a direction I think is better, which is, of course, my side of the debate. I think trying to push people in that direction that I think is better overall is the right course, even if it's going against the grain right now, even if most people are still like wanting to trade or hope for a dip so they can be, so they can have the same asset at a cheaper price. I don't think that's the healthy way to go. But for your positions, the points you've made, I agree with the points. I just want people to go in a better direction than what we're currently doing to each other.
Tooth and Giga went back and forth to talk about basically the philosophy of what happens if an entire community acts in a certain way. Well, we are looking at the specific liquidity provider right now, right? Like I've provided the wallet address of somebody who's heavily providing liquidity. Why does he do that? He does not give a fuck about what Tooth and Giga were just explaining. He does that out of self-interest. He has his assets and he wants to make the most out of that, right? So these are the two different talking points. What happens if an entire community, maybe even completely the entire pull chain community acts a certain way? And what happens if an individual does the certain strategies that we are here explaining in that space? And maybe we go back towards the individual opportunities that you have providing liquidity. What do you guys think? Should we do that? So,
Well, I can segue into that. Yeah, when your bags get big enough and you're providing liquidity, and this is one of the reasons why I like comparing liquidity providing to real estate, because I also look at LPs like rental units, and since like you can understand the analogy of putting your property up for lease or rent when someone wants to come in and trade, you might round trip your position. It goes up and down, and you collected the rent, the fees over time. And so a lot of people, they get really, really comfortable with the liquidity positions once their bags are big enough or once they have like a really good LP because it's just passive income. I spoke about this a few months ago when comparing Hex staking yield versus liquidity providing with Hex and ETH. If you had that position in day one, if you staked Hex day one and you round tripped the bull run all the way back down to the lows, you actually would have made more money if you had just popped the same amount of capital, 50-50 full range LP with Hex and ETH. And that's because the evils of impermanent loss with ETH holding more value than Hex did throughout that whole cycle, your dollar value actually would have been higher with the fees. Actually, I think doing more than double. It was like 150% in the fees. But most people, they get really, really comfortable with LP because once you buy that property, then you got a really good asset. Like just say you're using ETH and BTC for an example. If you got really good assets, the value of your property can just go up over time, especially if you're looking at a macro level while you're making your rent money back in the form of fees. So that's why a lot of people like providing liquidity, especially when they have bigger bags. Not less people than you think are waiting to like, try to buy the lows of a cycle and sell the top of a cycle. Lots of people get really comfortable with liquidity.
And then obviously what Tuspor's expanding here right now is more of a perspective of a long-term holder, long-term liquidity provider. You provide your liquidity in a big range, like wide range, and then let the market, trade in that range for a long time, ideally until the top of the market where you then would do another action, which can be in like another 8 months from right now out, right?
Yeah, it's basically going back into like why people are afraid of impermanent loss, and that's why I think it's really, really important to focus on liquidity providing through the lens of dollar cost averaging, so you don't put yourself in a position where it's like, oh, I could have sold so much more. It's like if you have the right mindset going in, you know what you're doing, you're going to operate differently and you're going to have different expectations. So like if you're looking to just like max sell something, sure, maybe you can wait, but then like the question I ask people all the time when they get afraid of impermanent loss, well, what if you thought you sold the top and you didn't? And then the token that you sold does a 2x after that. Why is that not impermanent loss? It's functionally the same. You sold at a specific price and the price kept going up. It's the same way it works in an LP. And so like there's a risk associated with that, not timing the market perfectly. If you sell too early, most people don't get to sell the top. If you sell too early, it's opportunity cost you're really missing out at. And that's the real point to drive home, that most people look at impermanent loss when they're actually looking at opportunity cost. So if you go into it with the right mindset, you're gonna operate way better. And you don't always have to pick a pair that's like hex and die. Stablecoin pairs usually have the most impermanent loss, but impermanent loss goes both ways. The reason why the hex and ETH LP I referenced outperformed hex staking is because of impermanent loss. Hex fell off of a cliff a lot more than ETH did. Both are pretty down, but because ETH retained so much more value, you were able to dollar cost average all that extra ETH on that side of the liquidity. You were able to dollar cost average. You got way, way, way more hex. So when you think about it unilaterally and you're like, only this token, well, people who aren't thinking about it the right way, they're going to see all this extra hex, right? But you still technically experienced impermanent loss because you had less ETH. You were dollar cost averaging into that position while earning fees. And you can round trip that position, fully round trip that position if you have volatile pairs higher and higher. Why do you really care that there's a change in ratios if both tokens...
That's
What?
the only time you don't have impermanent loss, is if the position comes back to exactly where you started. Like,
No, well,
obviously,
that's if you're yeah, if it goes exactly back to where it started.
if
But
it goes
that's what I'm
exactly
saying.
back to where you started,
If
that's
there's
the only
if
time you
there's a
don't have
change,
impermanent loss. So
no,
look,
no, yeah, but
we
with
agree on
token, a
like
token's never going to
99% of
be...
stuff. Just let me say one thing. We agree on 99% of shit to do with liquidity. I commend the effort to educate and make people less fearful of impermanent loss, but you cannot rebrand or reframe away from its existence. Like, it's just literally the name that is given to the way the math works. So
I
impermanent
didn't. I
loss
said
is
you
real.
experience impermanent loss either way. A change in
So
ratio is an impermanent loss. So that's what I said.
yes,
If
yes,
if
exactly.
hex goes down more than the other token, you're still experiencing impermanent loss. So
Yes.
you can't look at it just on one
Any
side of the
change in
pair.
any change in ratio at all is impermanent loss. So I mean, look, you could
Exactly.
rebrand, you could rename it to something else. Say, hey, let's call it something else that sounds more friendly, but it doesn't make it go away. And there's no such thing as
Right, but
impermanent gain.
that's why I say you have to reframe what impermanent loss is in your brain, because if you only think about it on one token, you're not looking at the full picture and you're going into it with the
Yeah,
wrong mindset.
yeah.
I agree with you.
I
So
commend the effort to educate people so that they're looking at the full picture, so that they can understand that the impermanent loss can be incorporated in the situation and they can still have something that is considered a win. Like that,
it's impermanent loss is a tool, but like I said, the tool is dollar cost
it's
averaging.
just a component of it that's inescapable. I wouldn't say it's a
Right.
tool because it's never useful. Like
It's a tool if you understand that you're dollar cost averaging. You have a fluid position that's dollar cost averaging from one token you want to the other token that you also want.
Well, I'd say the LP is the tool, but the impermanent loss is a definite
Well,
negative consequence.
I see
That
them
has
as
to
one and
be.
the same, because one
It's
doesn't
just
happen without the other.
just
But
semantics here a little
hold
bit.
on.
You
Let
mind?
me just finish my point. So like so to the point of impermanent loss, this is what I was going to finish up with the other part. Who cares if you round trip two tokens in terms of ratio when both tokens go up to a higher price? If you bought ETH and BTC 7 years ago and you had them in LP together, if they were at the same price, right? They're not right now, but this is just a hypothetical. If they were at the exact same price in terms of ratio together, but they were both 10 times higher in price, you experience zero impermanent loss, but your bag is 10 times bigger. So that's why you have to separate profits from impermanent loss. It's not the same thing. And just like understanding
Well,
that
the
difference of
answer
dollar
to your
cost averaging
question,
and
the answer,
ratios is
the
important.
answer to that question is you would have ended up with more dollar value worth of crypto if you hadn't had them in an LP and you'd just been holding the one that outperformed. That's the answer, right? And I think you might also be incorporating the fee gain into the equation, which you should if you're looking at the whole picture, but not if you're defining what impermanent loss is.
100%. And
I'm
this
not
is
defining what impermanent loss is. I agree with you, Tangent. I'm not defining what impermanent loss is.
Okay.
I'm saying that if you're avoiding liquidity because of the concept of impermanent loss, you're looking at it the wrong way.
I agree with
exactly.
that.
And
One thing that I know some people do is they just ask someone else to do it for them. Like they're just like, hey, can you just, because the person who's initializing it doesn't have to
Just
put very much money in. They can do it if they
just
know
use
what they're
chat.
doing,
Another way is ChatGPT.
or ChatGPT.
ChatGPT can help you out. Yeah.
Or one thing is actually, and everyone should pretty much do this, is you start with such a small amount that just in case, like even if you think you've done the math correctly, if you put a really small amount in, say you're doing like $5 and $5 on each side, and if you fuck up the math, the worst that can happen is you lose like $5, or maybe it's 10. That would be a really extreme case. And then after that happens, that will be our bots that have made that happen. And then the ratio will be correct. And then you can add more in after that. By the way, that has to be from 0 to infinity. So that you would be doing a full range pool, even if you're on V3 for that first initialization. In fact, that's actually something that's really important. On V3, if there isn't at least one person, like at least one LP position that goes the full range from 0 to infinity, and then the price moves outside of the ranges that are there, it can cause problems for the pool. Like you never lose the coins. You'll always be able to pull your coins out, but it can fuck the pool so that fee tier can no longer be used anymore. So
100%. So
you
basically
want
what
to
you're
always
saying,
have like one person or one wallet that's got at least, even if it's just a few dollars, like $5 or something that goes from 0 to infinity, just so that it can't like kind of break at the edges.
so basically what you're saying is if the chart does not exist yet, let's say you create your own token and you want to initialize the liquidity pool, start with the full range position first. And ideally you do
Yeah.
full range, small amount of money, put in the liquidity, and then you can add from there.
Yeah, and I mean, if it's your own token, you can, if assuming you haven't handed any out yet, at the very start, you can actually move the ratio to what you get. Like if you were to get the ratio wrong by accident, then you can actually move the ratio by buying and selling the token to where you wanted it to be. I mean, I don't know what the legal implications of that are, but you can do it and then add the rest of the lick once the ratio is correct. That's great as an example. Worth noting, though, that for the way that those APRs are calculated, they are estimates. So the DEX is giving you an estimate of what it thinks that roughly what you'll earn, what you could earn in APR based on recent volume trends. So obviously, because you don't know how those things are going to go in the future, it could actually end up being higher or lower than that estimated amount. For highly liquid, high volume traded pairs, then it's going to be pretty accurate. But if you're on some pair that's not some niche shit, then it's not going to be accurate. But for the purpose of Abit's example, the point here is to illustrate how that APR, how dramatically that can change with different with different parameters. It doesn't actually matter what those exact numbers are.
Because I don't know about you guys, but I believe Hex will outperform Pulsechain. And I believe Hex long term will be higher than it currently is. But if it is going lower, I'm willing to use my financial energy and let the market trade and earn the fees from that. And that is what I wanted to highlight here. So the first two examples were buy side liquidity, sell side liquidity, I believe you call it. This example is buy side liquidity, and anything in between is basically just V2 tight ranges, even in V3.
He said mitigate your risk by not putting your whole bag into LP. Just put some of it what you're comfortable with. It's not necessarily a point I agree with, but I'm really, really comfortable with liquidity providing and the really long-term thinking. But for most people, they might not want to go all in and full port liquidity providing.
Yeah, maybe another way to mitigate risk without actually putting in less would be to widen the range.
Really that simple. That's how you initialize a V3 position. It's just the ratio of token A to token B. Really don't get scared. Into what Tangent was saying, this is a community. When I got into Hex, one of the things I liked about Hexico so much is that there were so many informative people that were willing to answer any question you had, and they will help you do what you need to do. When I first got into Hex, I didn't even know what DeFi was. Never had a MetaMask or anything like that. That should still be present today. Don't be afraid to ask questions or ask for help if you don't know what you're doing. Of course, don't give anyone your seed phrases, but if you don't know how to initialize an LP, you should know someone that knows how to initialize an LP. If you don't understand the concept of impermanent loss versus dollar cost averaging versus full range versus concentrated, just ask. It's Twitter. It's an open dialogue. Just communicate. People are there to help.
The other cool thing is say if you're in the bottom of a bear market, then you can be providing liquidity, and because everything's pretty sideways, then you crush it because you're earning these and nothing's really happening that much. Or Spooky was giving us one example, if you've got two assets that are both going up and are relatively correlated, so that there's not too much shift in their ratio between the two of them, you can also crush. So yeah, there's heaps of situations where you can earn good fees out of LPs without any serious problems.
And of course, this is all speculative. Who knows what the prices are going to be? But I think for most people in this spaces, they're very bullish on Richard Hart assets. A great pair to get concentrated with, in my opinion, is Pulse and Pulsex. Because you can see there's a trend line. If you look at the ratio, if you price it in the ratio, you can see there's a trend line of PulseX outperforming Pulse, but not to a point where it's doing a 10, 20, 30x against it, right? They price up relatively the same in terms of price action going upwards. If Pulse goes up 10%, PulseX is probably going up 10%, give or take. But in terms of ratio, which is how you're going to initialize your LP, you can tell by the end of this cycle, it's highly unlikely that Pulse is going to be 5 PulseX to 1 Pulse, right? Who knows? But you can, within reason, guesstimate that it's not going to outperform by that much. So it's a lot safer to pick these pairs that do have some price correlation, even in ratio, to get concentrated. If you do something like 0.12 PulseX for 0.12 Pulse for 1 PulseX, which means PulseX is higher price in terms of ratio, you can get a pretty concentrated position with decent volume and decent passive income, because those assets are mostly correlated to a large degree. Whereas something that's like ETH and BTC, if after a long period of time you can see ETH is bleeding heavily against BTC, you might not want to get concentrated on a pair like that.
That comment that you made that we don't know what is going to happen, I think that really needs to be emphasized because you don't know what's going to happen, you can't really cry that much about, my LP moved and I ended up with more of this token or whatever, because it's like you could have been holding all of the other one that went down or whatever or didn't perform as well. So it's like not knowing the future, at least this is a hedge that you're going to earn fees, right? So
Thank you for saying that, because that's another point that I try to make with LPs all the time, because everyone's so worried about the quote unquote impermanent loss or the opportunity cost. This liquidity providing is a great way to mitigate your risk. And again, I just made this point about that the Hex and ETH LP. You actually mitigated your risk. If you full ported Hex on day one and you round trip that stake and it bled against ETH, then you actually lost more money in terms of dollar value than if you had provided LP. Why? Is because ETH in that moment of time throughout this bear market has retained more value than Hex. So going into the Pulse and Pulsex equation, say you did buy, $100, we'll just use small numbers, so $100 of Pulse and $100 of Pulsex, and you went into a concentrated position and you lost all your Pulsex for more Pulse because the price of Pulsex went up higher. Well, all you did is from that moment of time when you entered that LP, that Pulse X side, all you did is dollar cost average in profit and get more Pulse. You didn't wreck yourself. You dollar cost average from your moment of entry and you got more Pulse. It's a great way to mitigate your risk because, just like we said, you don't actually know what's going to happen. Sure, maybe PulseX outperforms Pulse by a 5-to-1 ratio. We don't actually know, but neither do you. So liquidity providing is a great way to mitigate your risk because maybe your moon math is a little bit off and maybe your moon bag isn't as big as you thought it was, or maybe it falls off of a cliff. But if you're providing liquidity, not only are you earning fees, but that anchor that might be holding you down might also be the thing keeping you afloat.
Yeah, the other cool thing about V3, because obviously it can be seen as a disadvantage that all fees are not being compounded and re-rolled into the actual LP, but in a situation where, say, if one of the tokens goes to zero and the other token goes to Valhalla, in a V2, you end up with literally $0. You lose everything. But in a V3, the fees that you earn of each of the tokens, they're kept isolated until you collect them. And so if one of those tokens goes and does like a billion X, then you'll still be exposed to the gains. And sometimes those fees can actually add up pretty quickly. Like they can become, I've definitely heard of people making, nearly 100% of the value of the bag in fees within relatively short timeframes. So in that sort of situation, you're almost can become like get a break-even position with reasonable pace. Obviously, that's like high.
Happens every day.
Volume. It happens often, but it's like not as a proportion to all the pairs that are out there. So more often than you'd think, but a low percentage compared to the number of liquidity pools that are out there at the moment.
And I believe that this cycle is nearing its end by the end of this year. Maybe we get a right translated cycle that goes into 2026. Again, I don't actually know, but that's my gut feeling somewhere between October and December. Now is your time to get those positions in, because like another reason, and this is going into the mitigating risk factor, why you want your positions in LP. If you were more recent into crypto and you haven't been here for more than one cycle, or at least since last cycle, if you're not dumping hundreds of thousands of dollars, you are going to have to suffer for at least 1 year just to buy the Bitcoin bottom. And if you're still going to be speculating on altcoins, you're going to have another year or two after that. So people who have been working their butts off to get decent positions in LP and they're understanding how to rotate those bags for the market and they're focused on the passive income, in the long run, they were going to be in a much better position because no one ever sees how brutal the bear market is. We've seen this time and time again, just in this ecosystem. I'm not going to name names, but I'm sure people who have been around for a while, they're going to be able to point fingers. A lot of people leveraged themselves very poorly from last cycle, and they dumped massive bags, and they still didn't have enough money to maintain their lifestyle, or just buy the dip because the dip kept dipping. It's so much safer if you work your butt off and get into a liquidity position, and you have to understand the cyclical nature of the market so you can manage your portfolio just like you would a real estate portfolio. 99% of the people in this room, they're not going to sell the top. they're not going to buy the dip, and the dip is going to be way after than they thought it was going to be. Maybe 2028, who knows? But chances are you probably don't have enough money for 3 years. Save yourself.
But comparing V2 with V3, talking about the single-sided to the upside, single-sided to the downside, and what can be achieved, what are the pros and cons.
Yeah, liquidity is funny. It sounds really complicated the more you listen to people talking about it, but it's really simple if you just start doing it. Just like Profeta was saying, to start off, don't full port it. Get comfortable with it. Try a full range position. Use your favorite tickers and just start doing it. You'll see the ratios change. You'll see how the fees come in. You'll see how you'll be able to use the fees. And then from there, you can start getting a little bit more risky, which it doesn't have to be that much risk. Like I said, Pulse and Pulsex, highly unlikely one Pulsex is worth 5 Pulse by the end of the cycle. Who knows? Highly unlikely. So maybe you start finding some safer pairs where you can go into a concentrated position to earn more fees rather than, because it's definitely not going to be infinity and it's definitely not going to be zero. So sometimes the full ranges just don't make sense if you know assets are relatively correlated. That's when the concentrated position really, really starts to make sense. But just start. It's really important to just start because it's going to make sense as soon as you start.
I think that's actually a good point that we have not covered yet. When does ranges make sense? When does V2, where you have infinite range, make sense? So far, we have also just discussed like one exotic pair like Hex with DAI. DAI it's not exotic at all. Or Hex with Pulsechain. These things are tier 1 assets, I would say. Our blue chips, like providing liquidity in these assets has less risk than providing Pika with Dito, for example, to very shit coins that can go to zero at any point, right? And in these assets, it maybe make more sense to use a wider range, than a tight range. In Hex and Pulsechain, I know the market. I know Hex will not go to $7 by tomorrow. It will not go to $100 at all. So therefore, I can distinguish a certain range and keep that for a long period of time. With shit coinery like Pika and Dito, I love these assets, by the way. I'm just making a point here. I would not know where a logical range would be. So therefore, I'm almost forced to do a wider range, right? Does that make sense? And then there's always the question, okay, what assets should I use to provide liquidity with? If you do Pulsechain, you normally always have the volume because people are using Pulsechain to trade in and out. If you use DAI, that's also very good. If you now use 2 exotic coins, right, then it is totally possible that there is almost no volume. If you find 2 assets that are shitcoins and have a lot of volume, then you have really found a rare opportunity. And where I have found this situation was with Most and Pump, especially in the first month when Pump tires came out. People were trading between Most and Pump like crazy, and it was the highest yield that I have ever seen between an exotic pair. So here you have to just do a little bit of research, look into the DEX, look on DEX Screener, and see what exotic pairs exist. And then if you have those 2 assets, put yourself into the position and provide liquidity. It can definitely make sense.
A good way to find them is when you're looking on the DEX screener, you'll see the positions of V3. They'll say V3 up the top. And if it's got 50K liquidity and 50K volume, that's probably a good pair to look at or start looking at.
Yeah, I like exactly that comparison. I do it all the time. I check out how much liquidity is there. Let's say $10,000 liquidity, but there's only $1,000 worth of volume. I don't like that too much. I would not consider that pair too much. But if there's 10,000 liquidity and also $10,000 worth of volume, I'm gonna look at that. This is a 1-to-1 ratio, and seems to be very interesting in this case. Then that's gonna earn a lot of fees. Then
I would say even if there was 50K liquidity and 25K volume, I would say also look at that, but then you got to see where the liquidity is. If it's spread out, then the people that are in range are making a good amount of fees because they're showing the 50K liquidity from a wide range where most of it is all spread out. So the people that are in range are most likely making a lot more than other liquidity pools. So you also have to look at, when you see the chart, you'll see a hill, right? And everyone's concentrated in the middle. But if you see high volume and there's not that spike where the price is, where a lot of people are providing that liquidity, then that's probably a very good option.
that's actually a very good point. If you see in Hex and DAI, there's a liquidity pool index screener that shows something like $400,000. But $300,000 of that is not even in the range. Somebody has just put the hex up there. Whenever the price goes into that range, then that liquidity would be active. But currently, not that much, hex DAI, I believe it is actively being traded. So like you can sit yourself in there and like participate and earn a good amount of fees, even though Dex Screener shows you there's $400,000 that you compete against. But most of these $400,000 is not in an active range.
Also, you have to understand that there's a competitive aspect to liquidity providing and how the aggregators and routers want to route. They're looking for the best pricing for when people hit that buy button or the sell button, right? So one of the advantages of having that concentrated liquidity, it's like in terms of price impact, it makes it seem like there's a lot more liquidity on the market compared to the 0 to infinity range. So sometimes it only takes a couple of people to get a concentrated position into a V3 to be competitive with an LP that's 0 to infinity that's significantly larger. On 9mm on base, someone added like 14K worth of ETH and BTC, and the amount of volume is doing it's more than the actual capital in the LP pretty much daily at this point, just because it's so concentrated and so efficient that the aggregators love it. They love pulling out of that pair. But if you put those pairs in full range, it wouldn't get touched.
I'm happy you brought this up because I was going to bring it up. I was just waiting for a good shot, but yeah, like if like all of PulseX liquidity is $5 million, even a position like 250 or $500,000 or something in a tight range is going to mean that your DEX is going to get all of the volume for that pair. Basically, if anyone's using an aggregator.
Yeah, it'd pretty much black hole the volume. If someone put it up in a range of like even 50% down to 50% up, and it was like a couple $100,000 worth of Pulse and Pulse X, it'd get a shit ton of volume just because it's that much more capital efficient.
I mean, Famous has just highlighted that the other day, right? Like he was saying, hey guys, just trade your Pulse X against Pulsechain or vice versa on the 9X exchange, and you will see where it routes through. Pulse X has like $5 million worth of liquidity in this pair. 9mm only, I don't know, $500,000 maybe, and still 50% of every trade goes through the 9mm exchange, and that is because the liquidity is concentrated. And all it really does is, like, if you have $100 worth of Pulsechain, do you really need to trade it in a thousands and thousands of dollar range against Pulse X? The price is not there. So why spread yourself thin into those ranges when the price will never reach there? And that's the only reason why V3 is more capital efficient, because V2 does exactly that. In V3, you don't have that problem. You put your money where the current price is, or where the people trade the price.
That's why I like V3 liquidity providing. It's very similar. It's like having a fluid limit order.
But you still need to exit, and they're still in permanent loss, at least with.
Well, sure. Someone has to come in and buy it, but I mean, someone has to come in and buy the limit order too. So that's why I like comparing them. It's very similar in functionality.
And I just want to
limit
you guys.
Because a limit order you set up at a specific price, but you could also set a specific price for V3 as well.
What happens if it goes past your limit order so like that you can get filled, because it has to completely fill your limit order in order for you to fill. So there's technically actually a little point of impermanent loss to your definition.
There's partial fills and
yeah, there's partial fills. Usually the limit order never goes to 100%. It always says 99.
Wow, that's impermanent loss. You didn't get everything.
Oh, it's the 1%.
Oh.
Goddamn.
That's easy. Thank you.
Yeah, you cannot edit your liquidity position in V3. You have to exit the entire position. You could maybe just take 50% off the market. You have that possibility. Oh no, I have a feedback.
That was me. Sorry, that was me. I do.
Right, so you have your position, and then you decide you want to change something. You could take 10%, 50%, or 90% off. You can exit it completely, but you cannot make any edits on the range while the position is going. And I want to give like another perspective of why single-sided makes sense. Just the fact that with single-sided, you only provide one asset. And when would you do that? Let's say you bought Hex very cheap and it made 10,000x, right? Do you want to get more? No, you don't. So therefore, you would only take hex and provide it single-sided, so that only if the price goes into a certain way, you lose your hex, and you're never in the situation where you get more hex because you don't want anymore. You're already overexposed. You have the gains already. You for sure. No, you do not want to get more hex, even if the price goes down. So that is a viable idea why you use single-sided versus V2 or like a 30-30 range in both sides.
Okay, interesting, interesting. Because to me, so look, when I'm adding I'll be honest with you guys, right? I didn't understand the fact that when you're adding like a V3, I know you guys said don't call it a sell wall, but I don't know what else to call it. Exit wall, whatever you want to call it. It says like what range do you want to put it? Do you want to put it 30% range, 40% range? That's not actually price range. That's in regards to the price versus pulse range. Is that correct? So it's not
Exactly, the
actually
ratio. Yeah,
the
the ratio.
ratio.
So
Yeah. So you
so
should
you're
always
going
be
in,
looking at the ratio.
you're going, you can actually make it so like that it's only between, let's say, 20% increase from that ratio and between 20 and 40%. And then in between that, you would be buying or selling and using all of your liquidity, however you're filled on how much percentage. If you're halfway through or a quarter of the way through, you're basically using your tokens in that ratio, right? So to your question, right, to someone, and I was trying to answer, but I guess I was wrecked, is like what I would have suggested for you to do, right? If you could be in two positions. Let's say you would have filled up, let's say 40% of your bag, and something happens, there's this bullish news, and you're like, shit, I don't want to sell in these ranges anymore. You could take out your liquidity, buy back your tokens, and assume that opportunity that you when you sold the token, so you kept selling it at a bigger price. Now you can take those tokens, buy back into that asset to get the full appreciation, or you could remove the liquidity, keep the tokens that you value that you don't want to sell no more, and put only a one-sided downwards with the same amount of tokens that you had in the pool, but you don't have to worry about if the price goes out of the range upwards. You're not losing anything because you're not providing anything on the way up. What you're doing is you're providing it on the way down. So in case you're not monitoring the pool and you're with, like, let's say for yourself, you're with your daughter, or you had to go to the supermarket and you want to still pick up the token that you're bullish on. So just in case it retracts just, a couple percent downwards or a percentage downwards, you're actually buying it up. So you're doing the opposite. You're actually DCAing in chunks, and you're DCAing at a lower price, which then means that you're buying back the tokens that you had already sold to an extent. And then you could remove that and say, okay, now I'm good. I got all my tokens back. And in the meantime, you just constantly got paid for providing the liquidity. And there's other options too you could do, but those would be the two main options of what you think you would want to do, right? That you could do that. And you're technically in the same position, where you believe in an asset and you took all your capital and put it in it so you could go and get the further gains to then make a new range, which you could create on the spot, or you could wait for things to eat out and for things to die down to see what's more constant. Or you could just say, hey, I'm good with this, and I'll only buy up the tokens with the tokens that I sold and that I ended up with DAI or Pulse or whatever. And then you could use that as a one-sided in case the chip down. You know what I mean? So that would be an
Maybe you
option.
can also highlight what the range represents, right? Because I want to just basically ask a question here. So in the front end, you can click on the plus and minus to change the range. Every single time you click on the plus, the price range goes above one tick, and like the entire price range is like symbolized by ticks, right? And every tick has the same amount of liquidity. But that's not the point. Now I'm asking you the question, Famous. When would you provide liquidity in only one tick? And when would you provide liquidity in, let's say, 100 ticks, which represents, let's say, 30% range? See what I'm saying? Like, when would you put all your liquidity in one tick? Or when would you throw your liquidity into 100 ticks?
Well, in one tick, it would be for an instant gratification, meaning that you want to sell only all the tokens, all at that price. If you want to do it at 100 different ticks, well, you're technically spreading out your money to try to get as much potential possible, but also you want to be as concentrated as possible with the one tick, So like that, you're providing the most liquidity in that one range. But if you spread out for 100, you're evenly spreading out your amount of tokens to say, I want to provide this much, or I want to make this thickness of coins in order to then sell it eventually. And you're providing it for 100 ticks because you believe it's actually going to be that volatile. But some people also would just put one tick just to get out because there's zero slippage and you get paid for it. So
Exactly.
it's
And
more than 100% of your coins.
this is exactly how I see it as well. Like if you provide liquidity and only this one tick, it's basically mimicking limit order, right? Like it goes above 0.01% and then it's already out of the range. And now you have like just transferred all your value from Pulsechain into Hex, for example, you know? If you provide liquidity in those 30% range, here your strategy is different. Here you are hoping that the price stays in your range as long as possible and you're more looking for the fees. While like providing in one tick, you don't care about the fees at all. You just want to go from one asset into the other as fast as
Yes,
possible.
and the benefits of limit orders in that example is that the limit orders you end up with what you do. With the liquidity providing, there's a chance it comes back to the original state and you lose all that tick and you get back into what you started with plus the fees of whatever you were able to generate. But on the other side, with the limit order, you don't actually make the fees in case it is a big chunk and it is a significant amount of money that passes through it. Because it doesn't have to necessarily be one guy. It could be a bunch of people. It could go up, go out of the range, come back down, go up, come back down, come up. It's an endless opportunity of being in that range. A limit order is technically a one-shot deal where it's like I want to sell, I want to sell 150 hex. Oh, sorry, 150 poles per hex or whatever ratio is. I was thinking of the die in my head, but you understand what I'm saying? Like you want to do that one time and it happens, either it does or it doesn't. In a V3, you're allowing it to occur as many times as the market is willing to do it. So those are the difference. But it would be mimicking an aspect of how the selling, like where the proportion of the sell is the same thing. You're getting out at that price and you're able to sell the asset or buy the asset at that price, just like a limit order. But the difference between a limit order and a liquidity position is a liquidity position is always there until you take it out. But a limit order is technically once it's all filled, it's done. You don't have another try. It's not going to happen again if the price goes up and then comes back. It's a one-shot deal. But the V3, it could be as many times as it's willing to reoccur.
Hey, I love it, man. I love that you all are actually discussing this because, I mean, me providing V3 liquidity, man, in the past 6 months has been an outstanding opportunity. And I know that you and everyone else has been trying, tell people like, hey, man, this is the way to go. This is the way to actually have your capital work for you. And don't worry about the impermanent loss because the truth is, the thing is about impermanent loss, the definition of impermanent is it's not permanent. That's just it. As soon as you do your intro in, it's going to change your ratios anyway. So the second that you put in, anyway, regardless. The thing is that you're offsetting your volatility by collecting the fees. And that's basically what, places like Coinbase and them do. While they, you buy their assets, they always go by the pairs, whatever. You're doing the same thing, but the thing is, you're using less of your capital on V3 versus V2.